Hello, everyone. Thanks for joining me today. We're going to be talking about one of the number one cash drain issues for inventory-based businesses, and that's buying inventory without a plan. 1 Corinthians 14:33 says, "For God's not a God of disorder, but of peace." When your inventory is out of control, so is your peace. So implementing tools like open to buy brings order through careful stewardship, allowing you to really cultivate both profit and peace of mind. Okay, so let's dive right in. I'm Jacob Curtis. I'm a CPA certified profit first professional and your financial guide. My mission is simple. I help business owners like you finally get paid, master your cash flow, and run a business that gives you freedom. I started Curtis Accounting Solutions because most business owners don't need more spreadsheets. They really just need a plan that actually works for them, even with inventory, seasonal sales, and some cash flow chaos. So if that's you, you're in the right place. Drop a comment, hit the like button, share this video, and let's dive right in. Now, think of your cash as fuel for your climb. Too much gear in your pack slows you down, and too little leaves you stranded. Open to buy is the trail map that tells you how much inventory you should buy, and you shouldn't buy more, and you shouldn't buy less. So open to buy is a live budget for your inventory. It says, based on what we expect to sell and what's already on the shelf, here's what we can open in POs this month. That's where the open to buy comes from. It's basically your budget. This is really proactive stewardship. It's not guessing. It helps you grow your business and make sure you don't overbuy or underbuy inventory. Think of it like a river. There's the beginning stock that you have, the beginning inventory that you have, plus everything that comes in that you purchase, your sales that go out the door. And we're really trying to aim right for the right kind of inventory you want. And the equation keeps us in that sweet spot. We're trying to target where we want our sweet spot to be with the open to buy formula. We don't want too much and we don't want too little. Now, as an example, company's revenue last August was, let's say, $100,000 in sales. They're trending at a 20% growth year over year. And so August forecast would be 120,000 in sales. There's no crystal ball, just some data and some diligence, right? You're looking at the numbers and looking at what expected. So if we continue with that example, if we want to have our inventory at 6 turns, we're going to keep 2 months worth of cost of goods sold or 2 months worth of inventory on hand. With 120,000 in sales, 50% COGS, your August cost of goods sold is projected to be $60K. 1/3 of that is $20K. And that's what our ending inventory goal really is. If you're targeting a 6 inventory turnover ratio, like an inventory ratio of 6, meaning go through your inventory 6 times a year, what you're really looking for is $20,000 with this example is your ending inventory goal. Now, if you plug those numbers in, if your ending target inventory is $20K and you're going to sell $60K, but you have $25K on the shelf and you have 8K that's, let's say, in route you've ordered, then you know the max you can buy is going to be $47K. And that's your open to buy for the month of August. As you're planning to get things out, you need to buy 47,000 more to make sure you have enough. Now you can plan for future months. You can plan for 3, 6, even 12 months out to figure out what inventory you need to buy in those months. Now, open to buy isn't just a set it and forget it. You need to reevaluate it all the time. It's just like when you're going on a hike, you got to make sure you're on the right trail and heading in the right direction, right? You check what the conditions are and things like that. And then you make shifts and make decisions based on what those are telling you. So if your weekly sales trends are going way above what you were expecting or they're way lower than you're expecting, we need to update what that plan is. And that's how we stay ahead of and avoid overbuying in inventory. Now, Profit First tells us what cash we can use and where that is. Profit First tells us where our profit is, our taxes, owner's comp, inventory, operating expenses, all of those things. It tells us how much cash we actually have. And Open to Buy tells you your ideal inventory levels. When you combine those two together, you're going to know exactly how much money you have to buy in inventory and where your ideal target should. And they create order out of the chaos that you once had, right? And that's some really good cool stewardship there. Now, the cool thing is on jcurtiscpa.com, we do have a calculator to help you calculate your open to buy. Scroll all the way down to the footer, go to the calculators page, and then you'll click on the open to buy calculator. Plug in your numbers and get your open to buy for the next 12 months. But again, this is really how we will be able to grow the business. And that's what's really key here. Now, remember 1 Corinthians 14:33, for God is not a God of disorder, but of peace. Let's bring order to your inventory and walk in peace. If you have any questions, comments, or need assistance with managing your company's finances, whether it's bookkeeping, taxes, or inventory stuff, please don't hesitate to reach out. I'm here to really help turn your inventory chaos into some predictable profit and experience real financial freedom in your business. So don't be afraid to schedule a call with me. You can do that by scanning the QR code on the screen or going to the first pinned comment, going to jcurtiscpa.com, clicking on book a call. And don't forget to follow me, Jay Curtis CPA and Curtis Accounting Solutions on Facebook, Instagram, Pinterest, and YouTube. Thanks for watching, everyone, and we'll talk to you soon.